The buzz on Wall Street today was about the big breakup at Hewlett-Packard. It's the second technology giant in the past week announcing plans to split the company in two after eBay. One of the new Hewlett-Packard companies will focus on its personal computers and printers. The other on the fast-growing corporate IT and technology services like data storage, servers, and software. Investors rushed in to buy HP stock, sending shares up nearly 5%. Josh Lipton has more on the reasons behind the split and what's ahead for the two companies.
Think internet scale with billions of users and devices.
Hewlett-Packard's CEO, Meg Whitman, used to argue that the company's business lines worked, in her words, better together. Not anymore. Now the company is splitting in two. One company, which is going to be called HP Inc., will be devoted to printers and personal computers. It will be led by Dion Weisler, who is an executive in that division. Whitman will lead the other company, which will be known as Hewlett Enterprise. It's dedicated to enterprise hardware, software, and services. Whitman says that the breakup creates two companies that can be more focused and agile in a rapidly changing marketplace.
Today is only possible because the turnaround has succeeded. Think about what we have accomplished over the last 3 years: a rebuilt balance sheet, an innovation pipeline that is significantly improved over 3 years ago. I would argue best in class in the industry now. An inspired workforce, a new leadership team, renewed confidence of our partners, our customers, frankly, our shareholders as well. But we had to gather ourselves as one HP. But now we're in the position to take advantage of what's going on in the marketplace and position these two companies for growth.
But there's another reason Whitman might have acted now. Recode, the tech news site, says HP tried to sell its PC division, but rivals such as Lenovo and Dell weren't interested. Investors cheered the news today. The stock is now up some 70% in just the past 12 months. Analysts who cover HP say the two companies could also be attractive takeover targets.
One of the things we wrote about this morning in our note is separating these two companies gives HP huge flexibility. EMC or someone else would never want to take on the enterprise, take on HP in total because you get the PC business. Now, as you separate these businesses, your options are open. If someone wants to come in and buy your HP enterprise, they can do it. If someone wanted to buy the HP PC, they could do it. They're separate businesses, gives you flexibility.
But other financial analysts are skeptical. They remind investors that HP's business lines are challenged for growth and face real long-term headwinds. Whether this spinoff can address those concerns and unlock value is the open question. Josh Lipton, Nightly Business Report, Silicon Valley.
It didn't get as much attention, but not to be left out. Liberty Interactive also announced plans to split into two separate companies after a late Friday board meeting. One company will consist of its popular cable shopping channel QVC Group. The other will focus on e-commerce. Shares of Liberty Interactive up more than 6% in today's trade.
Well, the Hewlett-Packard split is putting pressure on some other big companies to break up for the benefit of shareholders. Dominic Chu takes a look at which firms could be next to spin off a division.
Sometimes investors think that bigger and more diverse companies are better off as separate entities rather than joined together. And when they say better off, they mean a higher stock price.
Companies do this often because, one part of their business, it might be a part of their business that they pioneered, has become over time less attractive, is growing a little bit more slowly. And so to try to avoid having that part of their business continue to be sort of a drag on their more exciting part of their business, they spin it off into two parts.
On the heels of the HP and eBay separation announcements, some investors are wondering who's next. RBC Capital analyst Mark Su is suggesting that computer networking company Cisco do a similar type of thing. Food and beverage giant PepsiCo has also been the target of an activist investor, Nelson Peltz, who wants it to separate its soda from its snack food business. PepsiCo CEO Indra Nooyi has made it very clear that the company is better off with both units under the same roof. Then there's industrial giant General Electric. GE shares have underperformed the market over the last decade, and some blame the immense size and scope of all their businesses. GE has been shedding non-core units like the appliances side of things, but still has a lot of different units like energy, water, transportation, aviation, and healthcare devices. Now the question is, will other companies also choose to take a look at separations?
So when you see major players starting to move towards, splitting up and focused is better, invariably others in the industry follow.
Investors should keep a close eye on larger companies that have lots of different business units. If the stocks do underperform, someone could step in and propose a value-enhancing move like a spinoff. For Nightly Business Report, I'm Dominic Chu.